This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, San Francisco has fallen. I'm going to show you what's plaguing the big city, and it's going to shock you to find out which cities are soon to face the exact same problems. And while investors are cheering for a soft landing, I'm going to show you two charts on why the U.S. manufacturing sector is about to come crashing down. And we have new evidence the government is cooking the books. At the same time, we're facing a reality that France and Germany are about to plunge Europe and the entire world into a recession. And we've got a big announcement. Stay tuned for that. Now let's head over where we picked today's story up with a headline as San Francisco hit with credit downgrade over a commercial real estate apocalypse, and this is going to get worse. And what's really interesting to me is many people are saying that real estate prices can't come down, and they believe that what happened during the global financial crisis was an abnormality. It was something that just shouldn't happen, and that right now there's one thing we can count on, and that prices in real estate can only go up. But we're facing a lot of issues when we look at what's going on with builders. They're sitting on the largest supply in 14 years. When we talk about multifamily, it's massively overbuilt and developers are scrambling for cash. And now we're facing what's going to be a commercial real estate apocalypse with San Francisco leading the way. As Bloomberg reports that Moody's downgraded San Francisco's credit rating. This might trigger an avalanche of other downgrades from credit rating agencies in the weeks or month ahead. Both S&P Global Ratings and Fitch Ratings maintain AAA grades as of Wednesday, but that's not likely to last. As Moody's noted, the sea of change in office employment to a hybrid work model and reduction in commuting to the city's office core have led to reduced economic activity, very high vacancy rates, and depressed rents. And this is exactly what the problem is, because when you look at the value of a building, it's based on its ability to generate rent, and not just its theoretical ability, it's what it's actually generating. And because we're seeing this work from home move persist, what that means is we're going to see these values of these buildings continue to fall. And this is going to have a huge effect on local governments. But that's not the only issue. When you think about it, when people commute into the city for work, they support all kinds of businesses like restaurants and dry cleaners and shops and clothing stores, you name it. There's all kinds of industry that comes into play in the big cities. Well, these businesses are going away. You know, we talked about just the other day, TGI Fridays facing bankruptcy. Well, if you've ever been to one, you know you only find them in cities. You don't find them out in suburbs because they cater to, of course, the corporate market for lunch and after work cocktails. And you're going to see more and more of this face a big problem. Not to mention, you're talking government budgets are going to struggle under the fact that as these buildings lose value, well, that means their tax rates are going to fall. But that's not just it. It's going to get much worse, because the credit rating downgrade is just the latest challenge facing Mayor London Breed, who recently had to close a $789 million deficit in a new 2-year budget cycle. The downgrade will only make it more expensive for the city, plagued with violent crime and chaos because of failed policies to borrow in the municipal bond market. And in June, Barclays analysts told clients, while we're not overly concerned about San Francisco's credit quality, it will likely experience credit pressures for the foreseeable future, which could negatively affect the city's ratings as well as the ratings of some of its related credits. Those analysts said real estate property taxes represent 60% of the city's local tax revenue. So think about that. You think about every major city that's got big high-rise buildings that they're generating tax revenue on that are empty, and that's a problem because at some point they get revalued and those tax rates drop in terms of revenue, and next thing you know, it's going to put additional burden on consumers and other households at a time when they can't afford more taxes, which ultimately leads either governments have to lower their spend, which is going to have a negative impact on the economy, or they have to raise taxes, which will equally have a negative impact on the economy. And they warn that the revenues won't move much higher through the end of the decade. This might suggest that the deficit explodes from here, equals higher taxes and more excess out of big cities. And you start to wonder why companies like Amazon are calling for this return to office, because they know, and they make up reasons. Yes, we're more collaborative, we get things done, we really want people here, we like to talk to them. But the reality of the story is they're starting to realize that if people don't come to work, these cities are going to collapse and fail, and that is not good for business in either aspect. But what we look at, of course, many people believe If interest rates come down, values go up, but that's not how it works. When you start to look at the real estate sector, again, it's all about revenues. It's all about, of course, tenants. And when we take a look at this next chart, when you look at the unemployment rate in red against commercial real estate prices for the United States in blue on a year-over-year rate of change, it starts to make perfect sense. As people lose their job, the value of commercial real estate falls because the next thing you know, you've got empty buildings. Well, the problem we have now is they're already empty, and we're facing a recession, a global recession at that. Is going to lead to more people losing their jobs, even more empty buildings. It's going to be all-out chaos. It's not going to be limited to San Francisco. This is going to happen in every major city all across the U.S. But many believe it's just a function of if you lower interest rates, prices go up. Well, that's not necessarily true. Now, we can look at the current picture here and say, well, prices went down because interest rates went up. But how about we go back to the global financial crisis? We see that commercial real estate prices on a year-over-year rate change started to fall, and then they contracted. And when we look at the 30-year fixed mortgage rate, now I realize the 30-year rate is not how buildings are priced because they do interest-only loans. But nevertheless, what do we see? The interest rates fell and property values continue to decline. Again, it's all about tenants. And in this case, buildings are empty. They're going to be even emptier when we head into recession. And what you're going to see is a push, not just from the federal government, not just from states. You're going to see this from every government agency at every level. Get people back to work and get them quick, because once a lot of these mid and small sized businesses fail, well, what it means is you're going to have a lot of problems in the inner cities. They don't have the tax revenues to support themselves. And next thing you know, you've got to get bodies back. You've got to get the economy turned around. And if you don't believe me, wait and see. Now let's talk about the Boeing effect, because we said before, what's going on with Boeing is going to have a major impact on the economy. I'm going to show you two charts of why the U.S. manufacturing sector is about to come crashing down. As orders for U.S. durable goods decline on aircraft bookings, so we finally see it showing up in the data as bookings decreased 0.8% in September. Now for a second month, evidence suggesting that even though people book new orders, it won't even matter because they're not producing planes due to the strike. But if you're looking to make money in the markets, we got a big announcement for you. Now, you saw this trade our subscribers for our CTA Timer Pro took advantage of. We got stopped out near the top at near 25% gain, and we did this because we had something no one else has. We back tested our data. Well, here's the good news. The development team is done with the updates. We now, as of today, you get all the back tested data in the report. You don't have to go look it up. We give it to you anyways. We'll show you which trades have a 50% or greater chance of a positive return over 4 different periods that we back tested. It's going to change how you trade. Now, if you're a subscriber to Momentum Time Pro, we have that in a couple weeks. The dev team's working on that. But here's what you get. The daily reports, the tradable signals, my opinion on which trades you should do. Now you get back tested signals, stop loss levels, full tracking of trades and returns, a weekly update, a fully duplicatable system, a 30-day free trial, and you can even find out which trades I'm in and why. All you gotta do is hit the links below. This is a game changer. We turn the probabilities in your favor. But excluding transportation equipment, orders rose 0.4% in a sign that there's a potential turnaround here, at least for part of the manufacturing sector. Orders for core capital goods, a proxy for investment in business equipment excluding aircraft and military hardware, increased 0.5% after a 0.3% advance a month earlier. And though many businesses are still committed to making long-term investments, uncertainty about the November presidential election and future demand has caused some firms to be cautious about expansion plans. And finally, we're getting exactly what I've been saying all along in the show, is it's not about the election. There's no evidence that all of a sudden, as soon as the ballots are all cast, that people are going to run out and spend, because nobody knows exactly who's going to win and take over the White House. So the notion is somehow, depending on who's there, is going to cause all of a sudden businesses to run out and start building inventory, buying equipment, and consumers are going to come out and spend. It has everything to do with the economy and demand. And finally, for the first time, we start to see that maybe there's a possibility it's not about the election. It's about the fact that consumer demand is falling. Wait till you see these two charts. Elevated borrowing costs have also limited spending by some companies. And at the same time, further interest rate cuts by the Federal Reserve may help bolster demand and invigorate a struggling manufacturing sector. And what if it doesn't? Well, history says It won't. As we look at manufacturers' new orders of durable goods in blue on a year-over-year rate change against the federal funds effective rate. And here is the idea. When you see the red line go down, the Fed's cutting rates. Well, that's supposed to spur demand. You don't see any of that going in the dot-com bubble, as interest rate cuts did nothing to spur a turnaround in the manufacturing sector until they drop somewhere from up here around 6.5% all the way down to 1.6%. So I've been making the case of why rates are going to zero. There's a perfect example. And then experts say that's not going to happen. We're only going to go down to maybe 3 or 3.5%. That's where they need to be. You watch and see they're going to zero, because look at where the manufacturing sector is headed. And again, we head into the global financial crisis. There's a slowdown in manufacturing. The Fed's aggressively cutting rates, and look what happens. Manufacturing just plunges right off the cliff. And how about going into the pandemic? We know the Fed got worried as manufacturing slowed down, and this time they said, wait a minute, it's a problem. It's not like 2015 that turned around, so they started to cut rates. It was a pandemic that changed everything, and now look, we see a continued downtrend in manufacturing, likely to get worse. We have a 50 basis point rate cut that's going to do absolutely nothing, because recent Purchasing Manager survey illustrated a struggling manufacturing sector as the ISM gauge contracted for a 6-month in September. We also talked about the S&P Global data, which said things got worse. And why are they likely to get worse? Why are we going to see this? Because again, it has nothing to do with interest rates. It has everything to do with the consumer and the economy. As we continue looking at manufacturers' new orders of durable goods in blue, now against real retail sales. This is advanced retail sales less the consumer price index. Again, inflation adjusting them both on a year-over-year rate of change. And so what you can see is when real retail sales starts to slow down, as consumers start to get squeezed by higher prices and lower income growth, what happens? They spend less. And of course, when they spend less, then the manufacturers get fewer new orders. You know, the fax machines don't turn on and run because what do you see? Retailers and wholesalers have inventory. It's just not moving quick enough. And we see that effect continue. Again, as consumers spend less, you see new order growth go down. It happens again in the global financial crisis. This time you see real retail sales is virtually negative, kind of like what we're seeing now, and then it slows down and dips into contraction. What happens? Manufacturers' new orders plunge off a cliff. Now, you come back here to around 2010. What happens? Huge surge in demand because the Fed's cutting rates, doing QE, stimulating the economy, and manufacturers get ahead of themselves. And look at that, a slowdown because consumers didn't spend. You see that effect happening again right around 2018. And now we have 2 years of effectively negative real retail sales. Everyone's looking for a manufacturing rebound. This is one chart that I don't see it happening. But maybe there's something else we're missing. So let's take a look at this chart. When we look at retailers' inventories, and what you see in red is kind of the relationship here that makes perfect sense. Consumers don't spend, so inventories rise, inventories go up, you don't order many new products. And sure enough, what do we see going in the dot-com bubble is, again, inventories remained high, and it wasn't until inventory levels came down that order growth turned up. Then you see the same thing happen in the global financial crisis. But how about looking around 2010? What do you see? Inventories didn't drop much, but new orders surged higher. That's why orders came down. You see the same thing happening here around 2018. But look at where we're at now. Inventory levels, they're not dropping. In fact, they're headed higher. This is, again, a warning sign for the U.S. manufacturing sector that its days are soon numbered. But we talked about how the government's cooking the books. This one is just too much to believe, because for the 6 months out of the last 7, durable goods orders were revised lower. Let's check this out. August revised from 0% month over month is minus 0.8% month over month. That is staggering. What it says, the government realizes that we're in a manufacturing recession. They just don't want to admit it. And again, we talk about this Boeing effect spreading and how consumers are running out of money. Well, many believe post-pandemic there was this huge demand for travel, and airlines stepped up with more planes and more seats. And check out what's happening. Spirit Airlines to trim workforce, sell aircraft to help shore up liquidity. And when you hear liquidity, what does that mean? They're running out of money, my friends. That's what we're facing all around the global economy. And Spirit Airlines will cut jobs as it scales back its flight schedule and has agreed to sell some of its planes, which move comes as a low-cost carrier is struggling with financial pressures and exploring a bankruptcy filing. Again, if there was demand here, they wouldn't need to do this, and they already know it's getting worse, which is why they're going to cut staff and sell planes. These cost reductions are driven primarily by a reduction in workforce commensurate with the company's expected flight volume, again, going down because demand is going down. But it's not just Spirit that's facing issues. How about American Airlines? They lift their profit target despite stubborn high costs. Again, they can't get away from inflation, and the issue, of course, consumers can't afford higher prices. And still, the carrier continues to face high costs, seeing its non-fuel expenses are trending toward the top end of its prior guidance. Unit revenue, an indicator of travel demand and fares, should also decline as much as 3% in the current quarter. Again, not inflation adjusted, worse than the 1.4% decline estimated. American has been challenged this year by an oversupply of airline seats in the U.S. market, its failed business travel strategy, and disruptions such as the technology outage that affected several U.S. airlines. So again, what we see, it's not just Spirit, it's not just Hilton. We talked about them the other day. Look at American Airlines also saying we have too many seats, not enough bodies, not enough demand. And all this is going to do, you're going to see us continue to slow down in demand, more people losing their jobs, and then all of a sudden we're going to hit an inflection point, much like we're seeing over in the European Union. As German business downturn eases but French economy struggles, check this out. The contraction in the private sector eased in October, but it's still as bad, with the Flash Purchasing Managers Index by S&P Global rising to a still contracting 48.4 from 47.5 the previous month. While still below the 50 mark separating expansion from contraction, it exceeded the minor uptick predicted by economists. Again, everybody hoping they're seeing a turnaround, and what they don't realize is there was a turnaround. That was it. There is nothing else as we now head into the holiday season. The problem is the manufacturing sector around the world is in a synchronized downturn. The start to the fourth quarter is better than expected, with services growing at a faster pace and manufacturing not shrinking as quickly in the previous month, giving some hope to growth in the fourth quarter. But the reality is, as everything continues to slow down, as we see the Boeing effect start to spread across the world, watch out, because France's downturn, by contrast to Germany, who is already in a manufacturing depression, in my opinion, intensified due to a sharp and accelerated decrease in demand that was more pronounced in manufacturing than services. The PMI gauge slipped to 47.3 from 48.6, while analysts had forecast an improvement. Again, it doesn't matter whether Germany's economy gets a little bit better, but France's gets worse. You see the United States is getting worse. What matters is, all of a sudden, every manufacturing sector across every major industrialized country is in synchronized fashion here, heading to the downside. We know where manufacturing goes, services follows, but for the moment, everybody's still banking that somehow demand in the services sector will turn everything around. And yet France remains trapped in an economic decline as the fourth quarter begins, with challenges from the third quarter persisting. Despite early elections 4 months ago, keep in mind, they just had elections 4 months ago and it didn't get better. And yet, what is everyone saying here in the U.S.? Hey, once the elections are over, it's going to get better. But it didn't in France, as uncertainty continues to loom over the economic outlook, and that's what we're about to see starting in November. There's a lot of concern that the U.S. economy, it was not about the election. It wasn't that people were holding back their spending. It was the fact that they had no money, and unemployment was continuing to increase. The data would be scrutinized by ECB officials who are debating the path ahead for interest rates. The PMI releases are the first major piece of information to arrive after last week's decision to lower borrowing costs for the third time this year. Don't worry, they're going to cut rates, but as I suggested, as I showed you in the manufacturing charts, cutting rates will make absolutely no difference. The issue here is the consumers tapped out, not just here in the U.S., all over the world, and what they're facing is rising and persistent unemployment. And under that backdrop, what you're facing is a globally synchronized recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.